Well, 10-year Treasury futures have consolidated today, just a pretty muted response given all the headlines and the news that we've witnessed. Starting overnight, the overnight session was fairly flat for Treasury futures, despite the fact that Bank of Japan came out with policy rates unchanged, but putting upward bias towards their GDP and CPI forecasts. ECB similarly kept policy rates unchanged, but are committed to doing more if needed. That said, risk assets had a pretty good session overnight with regards to both Asia and European stock markets, but Treasury futures were basically unchanged. Now, going into the US session, things changed ever so slightly. We saw a slight downward bias in futures, yields ratcheting up ever so slightly higher, largely on really good data. Claims came out down 26,000, a big sigh of relief given what we saw last week. When you look at housing starts and building permits, both of those measures at 14 and a quarter year highs. Last but not least, the afternoon, a very strong 10-year TIPS auction. It needs to be said that real yields were effectively unchanged going into the auction, as nominal yields had a slight degree of the earlier increase, meaning yields did go ever so slightly, but they were all already higher going into that auction. Now, going forward, traders monitoring and wondering what it's going to take to escape that range that we've been trapped in between 107 and 119. Traders seem to think that one of the things is risk assets. How much can risk assets bear relative to the higher yield environment we're currently in? Any kind of inflation data would be very important to traders. Fiscal stimulus and getting that passed, what does that look like? And last but not least, the pandemic trajectory, vaccine inoculation rates, and how is the economy going to get restarted?